Welcome everyone to Money Show's Accredited Investors virtual event and our next presentation. My name is Natasha and I'm your host. I'm pleased to introduce Harry Dent, founder of HS Dent. He dedicates himself to identifying and studying demographic, technological, and geopolitical trends. Today, he will be discussing the greatest bubble in history. There will be time at the end of the presentation for questions. If you type them in the chat, I will present your questions. Thank you for joining us, Harry. We look forward to your presentation.
Okay, thanks. Hi, everybody. I have bad news for the economy and good news for people that want to make money. I call this presentation the bubble that never ends. I mean, this bubble started in stocks in late 94, first tech bubble peak, 2000 crash, 78% for tech stocks. People are like, what? Even I was a little surprised at that early on because I was predicting a longer term boom from demographic trends. And then we had the real peak of those demographic trends in 2007, as I predicted 20 years before. And then the Great Recession. Oh, but then the unbelievable happened. Governments just said, we can never have a recession or depression again. Of course, that's what it's looking like, a depression in 2008 at first. So they just printed money infinitely, as Mario Draghi was the first to call it that, even though everybody's doing it. And now with the COVID crisis, they're doing it again. So we're in this endless printing cycle, which goes against the real cycles, but the real cycles will win in the end. And I think this bubble has finally gotten to the point where it's about to end. And you need to understand, if you look, which I have done in the last 5 or 6 years when we've gotten into this bubble economy, when bubble peak, much more devastation and everything goes down, almost everything except for the highest quality bonds and cash. And so you can't just listen to a normal financial advisor and say, well, if you diversify, but no. This is going to be a reset of the biggest financial asset bubble, real estate, stocks, commodities, bonds, everything. And almost everything is going to go down, and you're going to have to get out of the way of this in the next 2 years or so, and then reinvest, as Joseph Kennedy did in late 29, only back then because shoeshine boys were telling him to buy stocks. And now you look at the small traders indexes on the internet now, and like everybody's like leveraged up 20 to 1 buying Bitcoin and tech stocks. So that's a great sign now. Now, real quick, what I do, simplicity. Leonardo da Vinci is the ultimate sophistication. I learned this the hard way from a lot of analysis. You can study a lot, but the fundamental trends require you to boil things down to their simplest fundamental, and that is what is most predictable longer term. So I tell people, look, here's my promise to you. You can see the key economic trends that impact your life, your business, your investments, and your family over the rest of your lifetime and your kids if you focus on these fundamental trends in demographics, technology stuff, things that don't change like the news and the politics every day in the markets. And I also emphasize we're in a unique time of unprecedented economic progress since the late 1800s. We've seen more progress in the last 120 years than all of human history in economics, and we're only halfway through a bigger long-term cycle that I study. So I'm your guy on cycles, longer term, medium term, and in the short term, I'm guessing like anybody else, but I'll give you some quick guesses at the end of this. Now, real quickly, my breakthrough first indicator in the late 80s, after studying demographics for many years, the spending wave. I figured out the average person in the US and developed countries spends the most money at age 46 back then, 47 now, 48 in some countries, whatever. I can take this and project a lag on the birth index, adjusted for immigration, any country. Here's the US back saying, here's what was going to happen. This indicator caused me in the early to mid 1980s to say, oh my God, we're going to have the biggest boom in history because the baby boom is the largest generation in history and it's global and nobody sees it coming in their earlier stages, okay? Now, what happens here? Very simple dynamics. People enter the workforce, they're a pain in the ass, cost a lot of money. Anybody know teenagers, okay? But once they enter the workforce, age 20 on average, 18 to 22 range for most people, They go up a steep spending cycle with productivity and they kick ass. That's what causes the economy to grow every 40 years, like 1942 to 68 and 83 to 2007, when new generations are rising in greater numbers into a peak spending cycle, which you can time down to the year. I had this at 2007, late 2007, all the way back in the 80s. And people said, Harry, you're nuts. You can't predict out that far. Well, that's what happened. The economy started to slow down after 2007 peak. And we've been living off of quantitative easing ever since, because the massive baby boom has been spending less and less. Now, real quick, just to let you know, I can do this on 600 categories of spending. The Bureau of Labor measures every year, including peak spending, peak savings, anything you want to measure. And of course, we know when people are born, get married, do all types of things. But I can just tell you, every consumer sector, which can boom more or less at different times in this up and down cycle, not going to get into that today. But just to let you know how predictive demographics are. How many economists and analysts do you hear talking about demographics? The simplest, most predictable factor in history, especially since people became middle class and higher income in mass in the first time after World War II. And then the baby boom exaggerated that. Now, I'm not going to go into this either because we only have 30 minutes, okay? But I have over 30 years started with the demographic cycle, this blue line in the middle, about every 40 years peaks, and added a even more important technology productivity cycle, you know, computers and all that stuff and software and automobiles and electricity and phones before that and stuff, okay. And a geopolitical cycle that is more positive and then negative every 17, 18 years, a 35-year cycle. That only affects stock prices more. The top two, the innovation cycle is most important, and closely behind that, the demographic cycle. And then, which people have invented a long time ago, a decennial cycle, okay, in booms and busts. With most of the recessions since I was born and entered the economy in the 60s, every 10 years between about the 2000, 2002, or 2020 and 22 and et cetera, okay? So when I put all these cycles together, there's times where they go up more. Not gonna get into that today because we're over that, the best cycle in history, by the way, but times when we see is 2020 to 22, they converge downward together. Now, central banks are fighting this and have been fighting this for years, but I say these cycles are going to win in the end, and you're going to see the biggest crash of your lifetime, and it's going to be a once-in-a-lifetime opportunity to load up on stocks and real estates and commodities and everything else. Now, another important cycle. I had this cycle back in the 70s when I was in college and saw this 90-year bubble peak cycles. This is simply 2 times that 45-year technology cycle. Every other technology cycle builds on the next, steamships and railroads for entire networks of transportation, then electricity and internet and portable computer devices and computers. I mean, these things happen, and you see bubbles. The bubbles in our economy happen on this 45-year cycle, and much, much more so on this 90-year cycle. Look at the middle of this chart, 1929 to 32 crash of that star. Now I've been saying since late 2019 and 22, the next crash. And again, governments are fighting this, but are you gonna fight these demographic cycles, this 90-year technology cycle where everybody's got the internet now, and now Bitcoin is the next big thing, but nobody has it and nobody understands it? I kind of understand it, but I'm telling you, we haven't even, this is a baby technology, a 1 to 2 year old here, and we're gonna see it bloom with blockchain like we saw, internet technologies in the next 15 years, but not now, it's gonna crash first. Now, real quick, Ray Dalio, great chart here from his book. When you see big debt bubbles, we see the top chart, debt comes up, so do financial asset bubbles, but then debt deleverages like it did from 1929 into World War II and just after, okay? And we've had the next biggest debt bubble, much larger in all financial assets globally. And it started to deleverage in 2008 and 9, and then the central bank said, no, we can't let We can't have unemployment. We can't have banks and companies fail. So they blew their way out of it by printing money. You see at the bottom of the chart on the right, massive printing of money, which it understates it compared now. We never deleveraged. The greatest debt bubble in history after 1929 in the 2008-9 crisis. And I am saying we're going to have to deleverage it in the next few years, and it's going to be short, sharp, and massive. And every 20 and 40-year cycles, this is more generational. We see major bottoms, especially the 40-year cycle, 1942, 1982, and again, projected ahead, late 2022. So if I look at all my cycles, and if you have a better cycle guy than me, I would love to meet them, and I'll either shoot them or hire them, okay? All of my major cycles, the 90-year, which is different from the 40 and 20, but it comes together in 2022 with these 80-year, 2 generational, 4 seasonal cycles, 2 booms and busts, growth boom, a depression, a maturity boom, 40-year generation cycles spin and then don't spin, 20-year half generational cycles, and this decennial cycle. Every 10 years we have seen, look back at your whole life, recessions about every 10 years, especially in the first couple of years of every decade, all coming together, all pointing to late 2022. And I still suggest this is why governments are fighting this so hard. They sense every time the economy goes down, even though they stimulate harder than ever, they realize, it doesn't really, it's kind of dead here. So they know that if this thing goes down, they're in trouble and the economy's in trouble. I'm just warning you in advance. Now, here's what happened to my wonderful spending wave indicator, 46, 47-year lag, shows when the economy is going to boom and bust every 40 years, which worked perfectly until the 2008-9 downturn. And as I showed, instead, they just blew up the stock market. They couldn't get people to borrow money by making interest rates lower because everybody overborrowed, corporations, consumers in the boom. So they just blew up financial asset prices. And that's what we have, the greatest financial asset bubble in the worst economy in history, the worst recovery, 1.6% average growth. So you ask yourself, why would the stock market be having the greatest boom and bubble in history when this recovery since 2009 has been the worst in all of modern history that we can measure, especially in the United States in our lifetime? It's not, it's totally artificial. Now, why did this happen? Very simple. I can explain the difference between where stocks are at 34,000, the recent peak, and 12,000, where that previous graph said they should be, because earnings per share have grown, and that's 120% difference, by the way. That much more than profits since 2009 when they did QE. Why? Because pushing all this money and pushing down interest rates allows companies not only to save money on interest and borrow cheaper and all that sort of stuff, but they can buy back their stock. They're not growing, but it's such low interest rates and easy credit when the central banks say nobody can fail and anybody can borrow. If you have a heartbeat, they just buy back their own stocks. They've been shrinking their stocks to make their earnings per share grow up, and that's what correlates with stocks. Overall earnings, if we go back, have been flat since late 2011. We have not seen a strong economy, have not seen growing profits overall. We've seen an earnings per share market artificially created by central banks. And you got to think, will this last? Not a chance in all of hell. And if this recovery lasts 2 more years, I will quit my profession and never say another thing again. I'll just leave with that before I go on. Now, what have we really gotten here? The truth is, this is the U.S. bubble in financial assets. Look how since World War II, we go up and down. Yeah, boom and bust cycles, valuations. This is real estate, bonds, stocks, everything. But then, in the 90s, when the bubbles and the lower interest rates and the stimulus, and then, of course, more and more every time a bubble crashed, we have this bubble that is $60 trillion, 6.5 times, 3.5 times GDP, when it normally should be a little more than 1 or 2. So just to come back down to reality, about $60 trillion would have to disappear in financial assets in the US alone. But here's my most, and remember this, I'm gonna have two charts you to remember. This is the first one. The most important statistic in the world today, 525 trillion, and it gets higher every day. This was my last estimate about a month or so ago. 525 trillion in stocks, bond, real estates and stuff in globally and in past financial crises like the early 30s and stuff. How much of those financial bubbles will disappear? About 40 to 50%, 60 to 80 in stocks, 30 to 40 in real estate, bonds, all this stuff. But that's the truth, okay? That says we could see 225 to 250 trillion dollars globally disappear from financial assets, which are money in people's, not their bank accounts, which they used to spend, in their financial asset accounts, brokerage accounts, and real estate and stuff, disappear. And if you think people lost that much money in their wealth, they would keep spending like drunk sailors here? I think not. And especially the Asians who've done this the most, they're the most paranoid. And they have 75% of their net worth in financial assets in China, and it's more like 40 to 50% in the US. So this is the problem. Central banks saw this debt bubble crashing in 2007 to 8 and said, well, how do we get out of this? Oh, we'll lower interest rates and make money available. That didn't work because everybody borrowed too much and didn't need to borrow. But they did realize if we keep pumping money in, it goes into financial assets because that's what they're buying, stocks and things like that. And it filters down, bonds, and it filters down in stocks and stuff. So that's what happened. They accidentally found that, we can keep the economy going by blowing up financial assets, and at least the top 20%, especially the top 1% that own most of those financial assets, will spend more out of the wealth effect. That's all that's growing this economy at 1.6%. The truth is, zero growth for Homer Simpson in spending in the economy, and 4 to 5% for the top 20% that control about half of spending. And that's why they're having such big impact. And what do we have since this blowout? Normally in recessions, you get rid of all the bad companies, all the bad debts, and that clears the way for people to grow and reinvest and people to go to better firms to work for. No, we kept all these douchebag companies going. This is actually at 20% now. Zombie firms. These are not small businesses, which would be a higher percentage. 20% of public companies cannot pay their interest and debt service. They're already failing. And if it weren't for all this QE, and we don't let firms fail and we don't mark loans down to market, they would already be dead, okay? Central banks now in this last downturn have printed massive amount to offset COVID. COVID was a big shock, but they printed massively more, and stocks have come up to that. And now they're similarly overvalued as before the COVID thing. And what are they going to do next? I calculate now 65% of GDP, fiscal and monetary stimulus, committed past and future in the last year and a half. And hey, we haven't got back to GDP, even though we've recovered G-shit. We haven't got back to the total jobs. The markets are acting like it's better than ever, and it's not. So what we really have is a series of megaphone patterns. Let me ask you how much I love megaphone patterns. In the short term, stock patterns are more important than fundamentals like demographics and technology cycles, because politics and overvaluation and all this stuff and stuff clicks in, okay? The best patterns I found are megaphone patterns where you're getting into the peak of a longer term boom, like the 65 peak that continued to go up, slightly newer highs in a 72, but we kept seeing crashes to lower lows. You have the momentum from a long-term boom back to World War II, and investors and businesses keep thinking, no, we're going up and things are good, and then why would it end? But the fundamentals are weakening, and the stock market keeps telling you no until you have the big crash at the end, like 73, 74. And by the way, after that, 80 to 82 crash, adjusted for inflation, went to substantially lower lows. Now we see the same megaphone pattern, 2000 first tech top, 2007 demographic peak. And now the 45-year and 90-year cycle, the most important cycle for stocks, is peaking right in late 2019, 2020 or so, and governments are fighting this, but this megaphone pattern projects that the Dow could be as low as 5,000 in a couple of years. And I think that, or maybe 10,000 minimum, is the likely target. Now, all types of indicators I go over, I'm just going to focus on one, the Schiller cyclically adjusted price earnings ratio. He's saying, well, it's not, and forget this chart for a minute. If you look back at it, this is the second most overvalued in the last 100 years, but not as high as 2000. I take that same chart and do a second adjustment from his, adjusted for the cyclicality of earnings, and say, I adjust for the growth of the economy. When stocks peaked in 2000, the growth was 4.1%, 10-year average. When it's peaking now, it's 1.6%. How could you possibly compare stock valuations at a 1% long-term growth rate and 4.1%? You can't. When I adjust it for that, even the Schiller indicator is way more overvalued than ever. Anybody that tells you stocks are not overvalued is full of you know what. Trust me on this. If not, I will quit my profession in 2 years. You got to give me 2 years on that, okay? Now, here's the most important chart. The second most important chart, megaphone pattern near term. Once we got into this artificial bubble recovery, only in stocks and not in the economy as much. The first bubble peak was in January 2018. And then we had a first sharp crash. Oh, something's wrong here. Oh, then more stimulus, and we go up again. Oh, late 2019. Oh, sharper crash. COVID stuff. Okay. Now we're in the final bubble here. These megaphone patterns, it's the third bubble, and that bubble almost always goes over the top trend line. They call it a throw over rally before it bursts. And then it goes to the lower trend line. Now, normally that might not be that bad. On this chart, the S&P 500 on this lower trend line, and I'm talking within 2 to 3 months, once we break back down on this pattern, which could happen anytime, and I think soon, 2,100, 49, 50% crash within months. How many people do you think expect that? And I would answer almost nobody. Even the bears may see a longer term crash, but I have studied bubbles in the last 5 to 7 years because we're in such a bubble economy. I not only looked at this and other bubbles, I looked at all the 7 major stock bubbles in the last 100 years, and the average first crash from a bubble peak, and this is the biggest by far, was 42% in just 2.6 months. The 1929 crash, more comparable to this, major bubble at the end of a major technology and demographic cycle, was 49% in 2.3 months. I'm just telling you, if you want to sit and hope the market goes up higher and sit through this, or think you can get out fast enough, good luck. If you're prepared, you may be able to. And that's what I do in my newsletter. We're keeping people on as long as the uptrend, the bottom line since March 2020 holds, which it still has so far around a little over 4,000, the S&P. Once it breaks that, if you do not get out, you are risking this crash. And I would say there's a high chance this is going to happen between early June and late August of this year. Remember that. If I'm wrong, I'll project it again, because this will happen at some point on this cycle. And again, we've been going up in a wedge this last rally. Okay, this bottom trend line here is most important. This trend line, if it breaks, which now it's up to about 4,050 or something, and it's going to keep going up. We break this trend line, that's when you really need to worry. I keep telling people, stay with the trend, because I've been through this predicting bubble crashes before. The central banks keep pumping it up, but when this breaks, the odds of this thing turning into that 50% crash in 3 months go straight up, and you better get the hell out of the way, or at least have put options if you don't want to pay tax on your gains, or if you want to guard yourself. And again, when things go down, the 2008, 20 crash was a quick thing that showed that Treasury bonds are the safe haven. When it looks like we're going into a short depression. This is going to be a bigger depression over a couple of years. The Treasury bonds, the red line, do the best. Gold does good at first and then says, oh, it's deflation, not inflation, because gold's an inflation. Then it goes down and it comes back. It's okay, but it's not your safe haven. Corporate bonds go down due to default risk, except for the AAAs. And guess what did the worst? Bitcoin. People are saying cryptos are a safe haven. No, maybe 20 years from now, if they become the standard for digital currencies, maybe not now. They are like the dot-com stocks emerging in the first tech bubble. They're going to crash the most. And of course, stocks did the worst, except for Bitcoin and crypto. Now, where do you go? Treasury bonds, not gold. Gold is an inflation hedge and a crisis hedge. The crisis hedge works at it right now and a little, maybe months longer. When this thing goes to hell, as it did in 2008, gold's going to turn over and crash as it did then. It's the Treasury bonds. Do you want to be in a 10-year Treasury bond and make 10% or more, or a 30-year Treasury bond locking in longer-term rates higher that fall more and make 30 to 40 to 50%, or et cetera? The TLT will do more than twice as well as the 10-year. You've got to be in long-term Treasury bonds. Cash will preserve your money. Treasury bonds will expand your money because it's the risk-free rates that go down in a crisis. The riskier rates in bonds, even though inflation turns to deflation, they go up due to default risk. And finally, here's the dot-com stocks that bubbled in the first tech bubble and then crashed. The internet index at the top, 95%. Amazon, the leading stock, 94%. I see the crypto index and Bitcoin is the same thing here, about the peak, if they had not already, and crashed 95%. And then I would buy Bitcoin at 4,000 for a longer term boom. It is Internet 2.0. It is the internet and digital technologies for financial assets. The first internet was for information and communication. So this is a big deal, but it's in the baby bubble, about ready to crash better than ever. And then the long-term bubble comes, and then I will buy it. Right now, I would sell out of Bitcoin when it crashes. Real estate will never be the same. People buy real estate earlier than they peak in spending. And people say, oh, this red line, oh, real estate's not as overvalued or adjusted for inflation. No, but compared to the fundamental trends with all this stimulus and people buying at zero interest rate, it's twice as overvalued. Real estate crashed 34% in the last tech wreck and downturn to follow. It's going to crash more than that, 40 to 50% this time. And again, how much net value is there to lose above mortgage? 50% more than last time. So sell stocks into any runs up, especially if they make a new high. See stocks, if you're in real estate, as the leading indicator, because real estate will follow if we go into a downturn. The downturn is going to be led by stocks crashing in this bubble. And again, what do you do in the downturn? Cash flow positive rentals and multifamily and medical facilities at least hold up well. Commercial and high-end real estate gets killed. Best safe havens, again, in order. U.S. Treasury bonds, the longer the better, 30-year. AAA corporate 20 bonds, not gold, not Bitcoin especially. Create cash and cash flow now to leverage the sale of a lifetime. To me, this is similar to late 29 when Joseph Kennedy sold his stocks in companies, whatever, when he was a multimillionaire, got out of the markets, rebought stocks and businesses after the crash, down 89%. This may not be quite as much, but it could probably be close, and became a billionaire. Multimillionaire to billionaire. Radical wealth if you see this coming. Now, I know this sounds crazy. I know this is radical, but we know our stuff cycles. This does not come from short-term stuff. Long-term research, as you can see. I have a free weekly newsletter for people to get to know us at harrydent.com. Sign up for that, and we can go from there. So if there's time for questions, I'm happy to answer.
Okay, you have tons of questions. A lot of them you answered about what you should be in if you're not in the market. And that you answered. Let me find some. What keeps the Federal Reserve from buying up stocks to divert a bust?
Well, again, you have to realize they've already constantly, exponentially bought more financial assets, starting with bonds and expanding to agencies and stocks in Japan and stuff. They keep buying financial assets to prop up the financial asset bubble. So what they don't realize is the debt bubble that started to come unglued in 2008, which is about $200 trillion in debt. Now it's 250 or more. This financial asset bubble, they blew up the financial asset bubble to offset the debt bubble. And now they have this 525 trillion monster. You think these academic, listen to me. You think these academic douchebags, Ben Bernanke, Janet Yellen, and Jerome Powell, who've never had sex and run a business, can deal with this bubble crash when it happens and be ahead of it? There is not a chance. Their biggest problem is they've blown up the financial asset bubble so big, they don't have to worry about the economy anymore. They have to worry about this financial asset bubble bursting, and then the economy follows, which is already the weakest in history if it hadn't been for all the stimulus. So these guys have already blown their wad. To me, the key indicator to me, the COVID crisis was so extreme that it allowed them to step up and go extreme. I am now counting with all of the monetary stimulus since the repo crisis just before COVID, and now the COVID crisis with the fiscal stimulus added, we're up to 55 to 65% of GDP pledged as stimulus to offset a recession. Are you kidding me? In any world or universe, does that make sense? These academic, I'll be nice, naive people who shouldn't be doing what they're doing without ever having a job will be embarrassed. And the best outcome of this, I am predicting that we will realize central banks should only create money in emergency crisis and should not ever try to manage the economy top down again and set short-term and long-term interest rates. That's what created this bubble much bigger than it should have been in the first place, and it's going to fail no matter what they do. These guys are screwed. We just have to decide, and I'm deciding the risks are getting very high right now in early June that this is about to crash and they're going to lose control of this. And you better be out of the way when they do.
Okay. All right. Here's a question. When you talk about the demography changes of U.S. stocks, are you considering U.S. Western demography only or other global demography? It should be, I guess.
No, excellent question. The Western countries, Europe more so, U.S. and North America also. Asia, no. Asia, well, China has peaked in 2011 demographically. Japan back in 1996. So East Asia was the first to peak, and then the US and in Europe, but Southeast Asia and India, again, some of the largest populations after China and East Asia are just in their infancy and urbanization and demographics. India will not peak until 2055 to 65 in demographics and urbanization and the things that really matter long term. So there is much more growth in the world, but you still have to realize that developed countries, even though they're about, less than 20% of the people, they're still way, over 50% of the GDP. We go down, the whole world goes down. The emerging countries, including China, which is already ailing, and it's going to have the worst crash, by the way, because of their debt and overexpansion. But India and Southeast Asia, which are going to be the growth areas of the future, they're going to get hit at first too, but they're going to be the places to invest. Coming out of this in 2 to 3 years, late 2022-23 time period, you're going to want to buy in aging sectors of the developed countries like the US and into the fastest growing sectors demographically, globally, which will be Southeast Asia and India.
Okay. So here's a question. You have advised buying treasuries to protect against the crash. Why not short the market?
Oh, okay. Okay, yes, that's a super good question, by the way. The first crash, remember I talked about 50%. I showed that megaphone chart in a couple of months. The first crash will be stocks going down across the board. Of course, some more than others, but 50% in the S&P guess, okay? Maybe 30% in the most defensive and 60, 70% others. Shorting that early on is the fastest way to make money in the downturn. After the bonds start to go up when they see the downturn in interest rates, risk-free rates go down. So the Treasury bonds start to go up in value as their risk-free rates go down, but not as fast at first. The Treasury bonds do the best, and look back at 2008 and also in 31 and stuff. When the crisis gets the worst and most of the banks and companies are failing, the Treasury bonds are the ultimate safe haven, and they do the best. So actually, I try to be simple for most people. Get out of stocks and risk assets and get into safe Treasury bonds. That's the simple strategy. The more astute strategy is be short stocks here. And especially now when we could have this crash in the next few months. And if that doesn't happen, then do it again. You can keep shorting stocks at low cost if you're wrong, and you just get out if it doesn't happen. Catching that first crash, simply short, not leverage, simply being short the S&P or the NASDAQ SH or PSQ or whatever, is the best way to make money in the first few months. After that, the stocks, have big rebounds and get volatile, and the bonds take over the Treasury bonds the more that the economy gets in trouble. And so that's what I would do. I'd be buying stock, shorting stocks now, if you're willing to take that risk and be a little more unconventional, because your stockbroker will never let you do this. You have to be thinking differently, like I am here, and which is good. And then once that first crash happens, I would start to get more into the bonds, or let them bounce, get out of the stock shorts, let them bounce. You know what the typical retrace is, any trader, 50 to 62%. Once you get a retrace like that off of a sharp crash, which you almost certainly will, then you short stocks again, or then you start getting more into the bonds. The bonds are probably a better play, all things considered, with less risk and volatility. The key is catching this first stock crash. And that's what I'm doing with people in my newsletter right now. I'm preparing people for this first crash, and I'm saying the most likely odds right now, early June to late August, for this potential 50% crash in stocks. And yes, being out is good. Being short stocks, you're up while everybody's down.
Okay. Do you think that further advancements in technology, for example, quantum computing, machine learning, could ameliorate your forecast for the burst? And
no, absolutely not. Here's why. Technologies, did I mention it before? Demographic cycles every 40 years, booms and busts. 45-year cycles, and now 90, the most important, double technology cycles where things build on each other. We're at the peak. There's always innovations, technology. So, and I'm telling you, I got known for demographics. I now have technology cycles as my #1 cycle, and demographics are #2 in importance. So I understand the power of productivity technology. There's always innovations in technologies, but it's when new technologies move out of niche markets into the mainstream, like automobiles from 42 to 65, and computers, in the early 80s into 2000 at first. And now again, that's when it's important. And so right now, the technology cycle is the cycle that is peaking the most and going to cause this crash. The demographic cycles peaked back in late 2007 and are only getting a little bit weaker. They're going to turn up in 2023. The technology cycle is not going to turn up until the early 2030s. So we've seen the best of that. But yes, I'll tell you another thing. I look at the dot-com stocks, and the internet first bubble peaked. The dot-com were like the internet, the Bitcoin and cryptos coming at the end, bubbling the most and crashing the most, and then booming the most. I see that the next big place to buy when we have this big crash that I think is highly likely will be the Bitcoin and cryptos, because it is Internet 2.0 for financial assets. And it will boom the most when the next demographic boom happens from 2023 or 4 to 2036, 2007. So I could buy a lot of stock in demographic sectors. I would be buying the crypto sectors, the ones that survived in this next crash, because they will outperform any demographic sectors, because technologies are more important. So I am cautious on this Bitcoin bubble right now. Remember I showed it the last slide. Go back and look at this because you guys can have the slides. That the baby bubble is peaking, whether it goes one more step up or not, and I think it's probably more likely peak now. The baby bubble is peaking, coming down. The daddy bubble is coming in Bitcoin and crypto from about 2023 into 2036 to 2040. So that's going to be huge. Are we off?
I'm sorry, no, that was me. Your questions are which treasury bonds would be best, and TLT versus ZROZ for a bond investment, and what exactly would you invest in? They're saying you're getting general questions.
So the longer term treasury is the best. 30-year, way better than 10-year. The TLT is an average 20 years, so it performs in between the 10 and 30-year, but closer to the 10-year, but in between. So that's the second best. ZROZ and some of these are leveraged treasury bond things, 3-to-1 and stuff. So you're going to get higher gains from that, but higher risk. I myself like TLT is the easiest to buy for a fall in yields and get much better than 10-year yields, but not 30-year. And then if you want to actually buy the 30-year bonds, that's the best. If you want to hold those for a couple of years, that's the best return on investment. But it's easier to buy the TLT. So I like those two choices for investors. The 10 years, forget it. If you're going to buy a 10-year, why not buy TLT if you're betting on lower yields? And if you're going to buy ZROZ or TC, other leverage things, well, you're just leveraging. Okay, so if you want to do that, fine. So you can buy, I think a leverage play on TLT, you're just adding leverage. So that's your choice if you're a trader and want to add leverage. But I say that buying the 30-year treasuries are the best and more flexible and easier TLT. Forget 10-year treasuries.